Hey, what's up? Name's Kyla. This is my channel where I talk about stock market news. Nice to have you. If it's your first time listening, welcome. If it's your third time listening, welcome.
My mind is a barrel, loaded clips in my guns tucked.
There was a lot that happened in the market this week, to say the least. So yeah. Also, my chair is squeaky. I apologize if you can hear it squeaking. I do read my notes. I'm a cheater. If you can hear me scrolling, it's because I've got this Logitech mouse. But this piece by Unusual Whales, I think, encompasses most of how the market was this week. It was just a lot of movement and the market didn't feel good. And it let people know that it was feeling ill. So thank you, market. I'm still seeing a little bit of a value rotation. Energy and financials experiencing a little bit of a pop, even though tech did end up recovering. Tech was pretty spooked by inflation fears, the rise in the yield, but everything ended up smoothing out as the week ended. So yay. Good. If you look at volatility, even the volatility of volatility was volatile. So how's that for a feedback loop? Just kidding. But it just shows you that, the VIX spiked by 25% one day, and then now it's back below 20. So had a pretty crazy week in the VIX. Shorts were out on the SPYs and the Qs. To call ratio reached the highest this year with a lot of short bets against the SPYs and Qs. People are pretty worried about inflation, monetary tightening, etc. People are just like a little worried right now. A lot of that is showing up in how the market is reacting and how reactive the market is being. With regards to economic data, there was a lot this week. So we had the CPI, the PPI, and retail sales, amongst other things. So working backwards, we had retail sales today. It cratered, it didn't grow at all, but they were like, hey, don't worry. As long as you spend money on services, it's all good. We just need you to spend money. Go spend money. Just do that because it's 70% of GDP. Businesses are also getting crunched on the supply chain end with the labor shortage in manufacturing and at ports, putting more pressure on prices. With regards to the labor market, initial jobless claims came in lower than expected, which is great. But the job market is a little bit weird right now. Part of the problem is that there's a shortage in manufacturing jobs. So people are either quitting their manufacturing job or they're not applying to them. And that's problematic because manufacturing is literally the backbone of most of the economy, even though it's probably one of the most underappreciated segments of the economy. A lot of job openings in manufacturing, not a lot of applicants, and that's going to create problems down the line. Because that's a huge measure of how we currently consume goods. So we consume a lot of products, and as well as how we measure economic productivity. There's a lot of job openings and a lot of people have said, oh, like employment benefits are too high, or unemployment benefits. We need to get rid of those so people go back to work. But the thing is, there are some data points that show that most of it is actually in middle or higher wage jobs. So those people aren't going back to work. It's more, which is interesting. It shows that unemployment benefits weren't too high, that there's probably other things like childcare, other things like that are influencing that. So that'll be interesting to watch. And it's interesting too because the entire US market is based on the cheap labor, right? So like how cheaply can you make a sandwich? And then how much profit can you make off that sandwich? And that profit on a sandwich requires you to have cheap labor. And people have gotten accustomed to a certain level of speed and a certain level of cheapness. So you can see it kind of with Uber, because not as many people are Uber drivers right now. You have higher prices and that's not great, right? Like people don't want to pay more for their Uber. They don't want to wait longer, but there's not enough Uber drivers. Labor shortage, a lot of expectations. So with regards to inflation, core inflation came in higher than expected, rising 4.2% year over year versus 3.6% expected. This graph is from Jack Farley from Real Vision. Thank you for sharing. Also, I was on their show, so if you want to check it out, I'll link in the description. But the market didn't like the higher inflation. It was like, whoa, inflation. I don't think that's something that I want to be a part of. And also with inflation, expectations really matter. It's a cat and mouse game with the market basically chasing this idea of inflation, chasing the Fed, who's gonna move first, And if you worry enough about something, you can manifest it. Yep. And that's what the market essentially might be doing with inflation to a certain extent. As more and more people, I'm going to do a separate video on that, like the importance of narrative in the market. But just know, like, as people worry about things, you're going to see that show up more and more in earnings calls, in sell-side reports, etc. So people are just going to talk about it more because people are talking about it. Most of the move in the core CPI was, of course, like these reopening items, so hotels, autos, used cars, etc. A lot of base effects there. Things that we expected to move, but the market is pricing in additional inflation beyond just the base effect. Also, with expectations and consumer confidence cratered because of inflation numbers. They were like, whoa, we didn't sign up for inflation. And that creates that feedback loop of like inflation. Whoa, did you hear inflation? Like, whoa. In the same turn, PPI data came in pretty hot too, and no one seemed to care that much. So growing 6.2% year over year versus 5.8% expected. And the market really didn't care at all. This was after the CPI print, so perhaps the PPI was priced in. The University of Michigan 5 to 10 year inflation expectations are at 3.1%, the highest since 2011. These are long-term expectations, meaning that people are pricing in a decent amount of inflation. The Fed keeps on repeating that it's transitory, meaning that it will end soon if it does happen. But obviously, the market doesn't believe them. So we'll see what happens there. The big issue here is that the Fed can't back up what they're doing, even if they want to. So now it makes sense for them to take their foot off the accelerator. Maybe not put their foot on the brake entirely, raise rates, but there is room for them to stop the asset repurchases, but they can't, because if then they do that, then they send a signal to the market that a rate hike would be coming. The market would go into a tailspin. So they have to proceed very carefully, and they've kind of backed themselves into a corner of not being able to do much at all. They find themselves in this infinite loop where they can't move, because if they do move, it'll spook the market. And if the market's spooked, that's really bad. Versus repo purchases, they're basically buying back all the bonds that were sold at the beginning of the pandemic, they're basically buying everything back through RRPs, and it's just that endless cycle. So monetary policy, very fun. There's also a lot of short pressure on corporate credit, with treasury yields poised to steepen. Corporate credit is pretty sensitive to higher interest rates, so people are moving away from that. And there's also better places to find value, such as in high yield and emerging markets, so people are rotating over there instead. Interesting, total fixed income assets sold to the world continues to grow. So there was this narrative for a while that people weren't buying our debt, but it turns out that they are, maybe not necessarily the treasuries, but they're buying BBB credit, which is essentially, the world seems to see BBB credit of the US and treasuries is basically the same. And with the level of Fed intervention, the conclusion isn't wrong. So take it that way you will. With regards to commodities, gold is a hedge against real rates, not a hedge against inflation, as a lot of people think. That's why gold hasn't moved too much, but it'll be interesting to see what gold does over the next few months. Lumber had a bit of a breather this week. It's actually down. Everyone always asks me about lumber, so that's my lumber update. Corn farmers are planting again, so that's really good. Glad to hear it. More corn. Corn makes whiskey. How does that song go? Rain makes corn makes whiskey. Whoa. Crypto. There's a lot of noise in crypto. The SEC called it a highly speculative asset in this paper that they released with regards to could Bitcoin be sort of integrated into an ETF? And it doesn't seem like either Gary, who is the head of the SEC, or the other regulatory bodies are too interested in having crypto as part of the ETFs. Gary himself said that crypto could benefit from greater investor protection. So we'll see what happens with regards to the SEC in that space. The DOJ and the IRS are both investigating Binance. So we'll see what comes out of that. Pretty bullish for Coinbase if Binance gets shut down. But yeah, things not looking good on the regulatory front for crypto, which I think sometimes we forget that institutions want a piece of this pie and they're willing to do whatever it takes to get a piece. So Crypto moved a lot this week because Elon Musk had a tweet about crypto. Elon sent things into a tailspin, and all the poop coins were pretty influenced by Vitalik, who is the founder of Ethereum. He sold off a lot, 1.3 million of his own dog coins, partly to clear up network congestion for Ethereum. And then also he wanted to donate to India, which was like really awesome. But that kind of sent the dog coins into a tailspin. And then Elon's tweet sent the whole crypto market into a tailspin. So he tweeted out that Tesla would no longer accept Bitcoin. That was really crazy. And then the next day he started tweeting about Doge. So we can all see where Elon's incentives are and what his main goal was by tweeting that. And Dogecoin is really this great example of narrative becoming reality. And essentially it's Elon's coin now. Like he has pumped that coin to have it have the value that it has. So that's his coin, 100%. Dogecoin and Elon are one and the same. And he has very craftfully created a coin for himself, which is, you know, he saved a lot of money probably by doing it that way. And now they're going to probably accept it for Tesla, maybe. But yeah, he created a feedback loop, he created FOMO, and now he's going to just piggyback off Doge. He doesn't quote unquote need Bitcoin, and Doge is going to move over to proof of stake for the ESG component, which, you know, Tesla's a part of the S&P 500, so they have to pay attention to that stuff. And yeah, Elon is really good at chess. If you didn't see my video, I'll include it right now. But buddy, it's Elon Musk. Welcome to my chess game. This is how I send my tweets. It's all strategy. We're all just mere pawns in the game of life. So you might be asking, how do you send your tweets, Elon? I use my TA84 Plus. Do some calculations. Oh, and then I refer to my word list. Yes. Oh, ignore these ones. Ignore those. Yeah. Doge, I've been doing that. Maybe tomorrow. This one. Let's do. I'll tweet about Doge. I'll say, meh. Doge is my favorite cryptocurrency. So I'll tweet about my own company, Tesla. And I'll say it's overvalued. Sometimes I make bigger tweets. Tweets that some would say move markets. I send. Welcome to chess. Tweet away. And Coinbase is going to host Doge on their platform, so collective belief in an asset does drive value. JPM is really interested in Ethereum, which is interesting. They seem to like it a lot better than Bitcoin, so it'll be interesting to see how Bitcoin fares over the next few months. I know that there's a lot of maximalists out there, so we'll see. We will see. Main thing, and I'm gonna have a longer video about this, is the importance of narrative. Like the market is driven by words right now, it's driven by communication. I talked about that in my Doge and Yellen video, but I mean right now, like Elon being able to move a coin that's based on decentralization and it's based on being away from, you know, quote unquote the man, but him being able to like have that much power just shows, I think, like sort of like how the market reacted with Yellen and rates. It shows how far we are away from a concept of decentralization. We can talk about that as much as we want, but we still get on Twitter every day or Instagram or TikTok or YouTube and try and find commonality. You know, decentralization is core to ourselves as human beings, and Bitcoin somehow rallied itself around Elon, or at least the people investing in it did. That's Bitcoin, right? The people who invest in it. I know there's underlying technology, but at the end of the day, you can have all the technology in the world, and maybe it can execute by itself. But if you don't have people who are investing and fostering that, then it's useless. People believe in Elon, and that gives him all his power. Just something to noodle on. You know, we saw how the inflation numbers moved the markets too, and the fear of those numbers. But yeah, bigger piece about that soon, so keep an eye out. Next week we have some pretty cool earnings, so Walmart, Home Depot, like the core, like big guys, like the big economic guys, they have earnings. Target, yeah. And then also more economic data, so super psyched, super stoked for next week. My little brother's graduating college. Everyone say congrats, little brother. I'm super excited for him. But yeah, have a great week. If you liked this video, go ahead and hit that like button. And if you wanna, go ahead and hit subscribe. I do this every week. Sometimes I try to post 2 a week. And if you want to see me talk for 1 minute every day, I do that on TikTok. Bye.